Hi there, I'm David Allingham, Portfolio Manager and Principal at Eley Griffiths Group. I'm here today to talk about our new emerging companies fund, why the small cap space is such an exciting place to be, and give you a few examples of both case studies, past and present. But first of all, one thing I'd like to leave you with today and make sure you take away is that the investment team at Eley Griffiths Group is a passionate group of investors. We live and breathe markets. At our heart, we're market animals. We're nothing better than getting a stock call right. We punch the sky when we have a win. We beat ourselves up when we get stocks wrong. But we always take something out of every investment. It's a learning journey. Also, the small cap space is such a great place to be. We're not looking to be either overweight or underweight NAB or Westpac. We're not looking to forecast the Telstra dividend yield. We're looking to get behind stocks like Xero at $14, not when it's on its way into the ASX 100 at 60. We want to be there at 14 early. We want to be on Afterpay when it was a $2 sort of IPO back in the early days. And equally, we want to be on stocks like A2 Milk right in its infancy as it progressed right the way through to the ASX 100. It's really the nursery ground for small caps. So who are we? Eley Griffiths Group was founded in 2003, 17 years history, and we're 100% staff owned, completely independent, which is quite rare in boutique land. As I mentioned, we're a small and emerging company specialist manager. That's where we really feel like we can add value and there's a reason for us to exist. We've got an experienced investment team, but it's not just experienced, it's broad. We've got Tim Sargent, who's an experienced resource analyst that brings a great capability. We've got Nick Wadira, who's joined us recently from CSLA 4 or 5 years ago with offshore experience. And of course, Ben Griffiths, our founder, who's got a lot of grey hair, was around on the 87 floor crash and has brought a great sort of discipline to the group culturally and from an ideological perspective. We've got 17 years of performance history. Not many managers out there that have that kind of track record. And of course, we've got an investment process that's been tested through a number of market conditions. And at its heart, our process is very much style agnostic. I want to leave you with the impression today, we're not a value manager and we're not a growth manager. We're style agnostic, and that really means that our view is we need to be outperforming no matter what the market conditions. We won't come to investors and say, sorry, we've underperformed, value was working and we're a growth manager. That's not our style. We think traversing the full market cycle and being an all-weather manager is important. So today, why small caps? We think it's a great place to be and it's a great place for investors to have their money with a manager. Typically, this was an independent study done by JP Morgan, and they highlighted some points that really resonated with me. I hope they resonate with you. Small caps tend to have faster earnings growth. They tend to have better balance sheets, which gives enormous flexibility. They also have M&A as genuinely a structural tailwind. It's a big part of what company management are capable of doing. On average, small caps tend to be owned by founder-led entrepreneurs. Being aligned with these kind of founders is a great place to be, and we think that key alignment is very important for all stakeholders. They typically are far less exploited than large caps as well if you compare them to large. The actual information bias that we talk about here is just a lack of coverage. If you're willing to roll the sleeves up and get down and do the work, you can really uncover some hidden gems in the market. And they're somewhat less exposed to some of the political trends that might be working against certain industries. But it's not just those 5 or 6 points, and they're all very relevant. But really one of the big ones we think is that small caps are also one of the largest beneficiaries of technology. Technology is a huge enabler for small companies. It wasn't around 10 or 15 years ago, this kind of enablement that exists today. And Afterpay, we think, is one of the best examples of this. Afterpay at its heart is a consumer finance business. It's not really a tech business, it's a consumer finance company, but it's used technology to disrupt the consumer finance space. It's now got 10 million unique customers, still growing at 100% through multiple geographies, and it has a $20 billion market cap, and it didn't exist 5 years ago. So we think this technology enablement story is very important to small caps. But of course, what's the proof in the pudding? Well, the real reason you want to back and be in the small cap market and back a manager in this part of the market is that small cap managers outperform. Over time, this is our small companies fund in the light blue. $100,000 invested in the small company strategy 17 years ago is worth $550,000 today after all fees. That's outperformed both the Small Ordinaries accumulation, our benchmark, which is only worth about $250,000, but most importantly for investors, it's also outperformed the ASX 100 accumulation index. That's with all dividends added back, by the way, for the ASX 100. So the point here is that you actually genuinely get an economic return on the fees that you pay over time, and not just that, a good small cap manager outperforms the broader market as well. It's a great place to be. So today I'm here to talk about our Emerging Companies Fund. We've been very excited for this launch back almost three years ago. And you can see here, it's exclusively for retail investors only. Minimum investment of 10 grand. Equally, we're taking some high net worth money as well. It's a unit trust structure with daily liquidity. That's important for investors. It's the same team. It's the same investment process that's worked for 17 years. And the fee structure is identical to our small cap strategy. We aim to outperform the Small Ordinaries Accumulation Index over a rolling 3-year period. And what I'd highlight here is the very, very strong performance the fund's had now 3.5 years in. So we're very confident our process and team are going to continue to deliver a lot of performance for our investors over time. You can see there the last 1 year, 14% absolute return versus the market at 2. On a 3-year basis, 20% plays the market at 8. And since inception, 21% after all fees versus the benchmark at 8, leading to 12.5% after fee outperformance. Very strong numbers. Equally, what's very important here is that during the downturn, we've got a fund that can work very well in up markets, but when we get a COVID-19 event, this microcap emerging companies fund gave performance like a larger, smaller companies fund, a more conservative defensive fund, and so that was very pleasing. We fell less than the market did into the March 23 low. I'll just make a couple of points here, and that's really that we are not allowed to do any personal trading in that X100 space. If we want to have emerging companies exposure or small cap exposure, we must be in the fund. The capacity of the fund will be tightly managed to 300 million only. We're going to keep it there to drive strong performance, and funds currently around 140 million. It invests exclusively outside the ASX 200, typically 35 to 55 stocks, and the average market cap, to give you a sense, is about 400 million. So we're really in that sweet spot of companies that are growing momentum, growing liquidity, and are moving into index inclusion, which is where a lot of the outperformance can be generated. So what's our approach? How do we do things? What's behind our stock selection? It's not just finding a cheap stock that's growing. That's an important part of our overall quantitative assessment. But what we really pride ourselves on is doing a lot of the qualitative work. That is stepping out behind the Excel spreadsheet, getting into the real world. What's happening in the business? Is the model scalable? Who are the management? What are the board like? What are their strategic goals over time? Those soft touch and feel things. And I think these two examples give a great examples of why things have worked. If you look at Pinnacle Investment, it's a holding company for a whole range of boutique managers, and you can see it there. $1,000 invested in Pinnacle is worth close to $4,000 today. Whereas if you'd invested 5 years ago in the rest of the sector, Pendle, Platinum, Janus, Perpetual, you've done half your money. So look, why has that worked? Well, we think the business is scalable. It's got multiple organic growth opportunities. Ian McCowan, as the largest shareholder, has managed to attract a number of very high quality fund managers into his boutique brigade. He's delivered consistent EPS growth, and he's got encumbered with legacy funds under management. And these are the kind of qualitative things that we like to get to the bottom of in a story and look at that outperformance. Another sector, Elders, in the agricultural sector. What a bloodbath that's been for investors over time. It's a great thematic, but it just doesn't seem to work for investors. Well, except for Elders. $1,000 investors in Elders back in 2014 is now worth $11,000. That's almost a 10, well, it is a 10-bagger. Look at New Farm and Grain Corp, flat in 6 years. So again, what's worked there? Well, we think it's Mark Allison and the extremely disciplined approach to capital investment that he's brought to that business. Agricultural companies tend to have balance sheets that are overgeared. They can't handle the volatility in the agricultural cycle. And of course, Mark's also made some careful strategic bolt-ons, but it's that return on capital focus, a disciplined financial sense in that agricultural space that's missing in some of those other names. And that's why we've had such great outperformance in those two names that we've owned in the sector. So going forward, opportunities in small caps. What lies ahead for investors in our funds? What kind of stocks can you expect to own? Well, Saracen's one of the great examples of a stock we've owned. Tim Sargent, who's, as I mentioned earlier, has some extensive resource experience and network in WA. We backed Saracen, led by Tim, back in 2014 when it was a 40-cent stock. We owned just under 5% of the company. That stock, as you can see on the charts, now well over $5 in the actual ASX 100. And backing Rayleigh Finlayson there and his team, the way they've managed to make acquisitions, organically grow the gold production over many years, has generated a lot of wealth for our investors. So what's the next Saracen? What do we think's got that kind of potential? Well, I'd point you to the bottom right of this chart, Capricorn Metals. Capricorn Metals is effectively the reborn Regis management team. Mark Clark and his team, who built Regis Resources again into an ASX 100 gold producer, only to leave and join Capricorn Metals to basically build and commission their Karlawinda gold project. That project will produce about 130,000 ounces per annum of gold at about $1,200 cash cost, so good, healthy margin. But that's not what we're there for. That underpins the current share price. What we're there for is what Mark and his team want to do in the future. And we saw them build gold production at Regis up to 450,000 ounces, and we think, about 400,000 ounces, and we think in Karlawinda is just the start of a major gold producer here with Capricorn Metals, so a big 4% holding in our emerging companies fund. And of course, Afterpay. Can't have an Eley Griffiths Group presentation without the Afterpay story. And what a stock that's been. Sitting down with Anthony Eisen and Nick Molnar back in 2016, post the IPO at $1, getting to understand what this business was doing, modelling it in detail, the customer additions, getting the third-party validation from retailers who were referring to basket size, conversion rates improving. We knew they were onto something here. Now, not only that, we left the modelling behind and we actually went and used the product extensively ourselves. We went through reviews on social media, in the Apple iTunes store. We used the product extensively. We spoke to friends who were using it, and we got great confidence they were onto something very differentiated that was resonating very strongly. And we importantly, and this is where the real test came, we sort of stared down the cynics out there that were there all the way from $2 all the way up to an ultimate exit. We're now no longer in the stock, but it's been a great performer. So what are the future leaders? What are the Afterpays of tomorrow? Nothing will be quite like Afterpay. It's a once-in-a-generation event, but we think both PushPay and PointsBet provide investors with some very, very material upside to very large markets, and these two stocks are both in both of our funds at the moment. PushPay is the leader in digital giving solutions for the US church market. Digital giving and donations are about 30 to 40% of a total church's donation pool, and PushPay has about 60 of the top 100 mega churches in the US. These are 50,000 style membership organisations. They're the leader in that market, and COVID-19 has been extraordinarily structural accelerant for their business. We think churches have realised the importance of community and member engagement via technology and digital giving by the apps. And so we think PushPay is extraordinarily well positioned. $5 billion US was transacted through their donations giving app last year. We think that number will be close to 7 this year and growing. The total pool in America is about 100 billion. Now they're not going to get all the way there clearly, but they've got a long tailwind of structural tailwind behind them. PointsBet, on the other hand, a little bit more up the risk curve, burning a lot of cash at the moment, but very smart operators. Ex-Tom Waterhouse guys have entered the market late in a mature setting in Australia, but managed to get some great market share. They've owned their own software. It's all cloud-based. They've got some great features that are unique to them. But most importantly, this story is all about the US and the deregulating market over there. They entered the New Jersey market late, but generated 5% share in the New Jersey market. You know, the rest of the market's opening up, including Illinois just this month. We think they're going to get more like 10 to 12% share in the Chicago market, Illinois. And so we really see PointsBet as a $30 billion addressable market story. And these guys, if they can generate 5 to 10% market share with the backing of their NBC marketing partner, we think there's significant upside in that stock over time as the true economics of the business come to the fore. So finally, I just remind investors, we're an all-weather manager. We like to manage money through the full market cycle and deliver investors a return over that time period. If you've got a sense for the kind of stocks we like to own, we're not just tech junkies. We like value names. We follow cash flow. We have fundamental valuation parameters that we look at. And if you have any questions at all, please reach out to John Price, our head of marketing, on the below details. Thanks for your time.